Good evening, ladies and gentlemen. Thank you so much for joining me once again. So the purpose of this video is to show you 4 types of loans that are very common out there right now. And I want to talk to you a little bit about them so that you can get familiar with them. So next time you come across them, you know what this type of loans are all about. And so therefore you can make a better decision on what is best for you based on your financial needs and for your family, so that you can make the better decision of purchasing your home with the right loan that is best for you. Stay tuned. All right. So like I said, I'm gonna briefly talk about 4 types of loans that are very common out here in the Southern California area, actually in all of the country. But as I do transactions out here in the Inland Empire, I want to talk to you about this type of loans, so therefore you can gain a little bit more knowledge about them, and then therefore you can make your decision when making a new purchase. So what I would like to do right now is I'm going to briefly talk to you about the VA loan. So the VA loan, what essentially stands for is for Veteran Affairs. The VA loan, therefore, is for eligible veterans or active duty members and qualified surviving spouses. Actually, the VA doesn't set a credit score benchmark, but most lenders will have one, and it's typically right around 620 FICO score. It is a very common minimum. So for me personally, I used the VA loan when I purchased my first house. I eventually refinanced and got out of it into a conventional loan. So right now I have my VA loan freed up. So when I do decide to make another purchase, I can use that. With that being said, let me tell you a little bit about what the VA loan has also to bring to veterans. All right, so VA loans are obviously backed by the government. They are issued by private lenders, but VA loans do not offer a down payment, which is also very huge. There is no mortgage insurance when you get to it. Typically, when you get into a conventional or an FHA loan, if you don't meet the 20%, there will be a private mortgage insurance. I will get into that later, but right now let's stick to the VA loan. So with the VA loan, you don't have to give a mortgage insurance payment, and it actually requires you a lesser credit score. So the VA guidelines are account for borrowers whose finances may have been affected by their service. The credit score requirements are typically lower than those for conventional loans, and their programs allows for a little bit more wiggle room. Essentially, what the debt to income ratio is that the lender is going to measure how much debt do you have to how much income do you bring in. Okay, so one of the things to watch out for the VA loan is the program is designed to help veterans and military members purchase safe and structurally sound homes they'll occupy as a primary residence. The VA loan will not allow you to buy this property and rent it out as soon as you buy it. That's going to go against the guidelines for the VA loan. So very important to know. One of the things that I would like to share with you all is that if you are service connected, meaning that you had an injury while you were serving in the military, this VA funding fee will be waived. Very important to know that if the lender doesn't bring it up to you, that you are aware of that, so that you can therefore waive those thousands of dollars that will be added to your funding fee when you close the deal on the loan. So essentially, this is what the VA loan is. It's only made for armed forces, whether active, duty, reserve, or veterans such as myself can get the benefit of getting into a VA loan. You don't have to give a down payment. When you don't give the down payment, guess what? You automatically waive the private mortgage insurance. And there's a lot of benefits that come to it. But one of the catches is that you must live at the residence as a primary use for your own residence. So let's get into the next type of loan that is out there available for you, which is the FHA loan. Now, typically the FHA loan is for people that cannot come up with the 20%. What the FHA will do is you will be required to give a 3.5% down payment with a minimum roughly about 580 score. And just like the VA loan, the FHA program increases the access to home ownership through lower down payment options, competitive interest rates, and less rigorous underwriting guidelines. One of the things to watch out for the FHA loan is that it will have an upfront funding fee. Much like the VA loan, it's going to have a cost. Why? Because these are type of loans, just like the FHA and then the VA, they're backed by the government. So they will have an upfront funding fee. Unlike the VA, where you can waive it if you are injured as part of your service part of your service, the FHA will not waive that. So you will have that added to your loan on top of a PMI. PMI stands for, it's a private mortgage insurance. The private mortgage insurance, it can easily range from anywhere to $150 or more on top of your monthly payment. Note this, that the additional $150 to $300 for the private mortgage insurance, this will not reduce your principal amount on your loan. This is an insurance essentially for the government, saying that you as the borrower will pay this off, and if you don't, that is essentially why you're paying this private mortgage insurance. Again, the FHA gives you more access to home ownership through a lower down payment, which is only 3.5%, a little bit of higher interest rate, and guess what? You will have to pay private mortgage insurance. These are things that you need to educate yourself, and then you can always ask a lender, reach out to your local realtor, or you can always ask me as your realtor, and then I'll be happy to answer you those questions. All right, ladies and gentlemen, so now we got to the USDA loan. This type of loan is a little bit more complex. The reason why I say that is because there's a lot of restrictions that come with it. So essentially, who can use it? Buyers looking to settle in an approved rural area who have adequate but not excessive income and in an acceptable credit score, who are the ones that can use the USDA. USDA lenders often ask for at least a 640 FICO score. So what does this mean? That you cannot get into a USDA loan if you exceed the maximum amount of how much money you make in order to get a USDA loan. So again, you cannot get this property down in downtown San Diego where you see all of the buildings and try to get a USDA loan. It will just have to depend on your county, your city, the state that you live in, where this house is located, that then the lender will allow you to get a type of loan such as a USDA loan. Very important to know to get with your lender when you're trying to get a USDA loan, because USDA loan will open up the doors for you to get into a home and become a homeowner. However, a lot of factors have to be factored in, such as your credit score, such as your income, and where the property is essentially located. But then again, this type of loan makes it accessible for individuals out there to become homeowners and get into the market when purchasing a home through a USDA loan. All right, ladies and gentlemen, so we finally got to the last one, which is one of my favorite ones. This is the conventional loan. Essentially, a conventional loan, it's not the same as cash, but it's just as strong as cash. Why is that? Because the conventional loan has a lot of power. It doesn't come with a lot of restrictions, and then essentially it has more purchasing power for the borrower to go out and buy a property. Who can use it? Anyone with a qualifying credit in the ballpark, let's just say 660 or higher with an adequate income can use this loan. A minimum of 5% nowadays is acceptable when getting this type of loan. Why? Because home prices have been on the rise for so much within the last 2 years that the government, not the government, but Fannie and Freddie have allowed this to happen. So before, it was typically you get a conventional loan with a 20% down payment. Obviously, when you get the 20% down payment, you don't have to pay pre-MI, and you don't have to pay the upfront funding fee. So essentially, you save yourselves hundreds of dollars in the process. Okay, again, so a brief recap of what the conventional loan is all about. You don't have to give the entire 20% to get into a conventional loan. as long as you have a steady income and a solid credit score, you can actually get into a conventional loan. This is not backed up by the government. This is backed up by Fannie and Freddie. So essentially, you, when you get this property, have the ability to rent it out if you choose to. You don't have to use it as a primary residence, unlike the VA, the USDA, and the FHA loan that comes with restrictions. You can get a conventional loan and eventually rent it out. So again, you can get into a conventional loan with as little as 5%. Typically, it used to be 20%. Now you can get it with as little as 10 and even 5% down payment. Note that when you do get this loan, you will still have to pay the PMI, which is a private mortgage insurance. Now, note this and ask your lender, when you reach an equity that amounts to 20% of your home value, then ask him if you can get rid of the PMI, the private mortgage insurance, because at least here in the Southern California area, you can do that. So very important to know that when you get into conventional and you give 5% down and you pay that private mortgage insurance, essentially you can use this property to go out and rent it out. So guess what? Your tenant will be paying for this PMI. Unlike the FHA, you have to live in that property for a minimum of 1 year. And the VA loan, it has to be your primary residence. But again, with the VA loan, there's no PMI, there's no down payment. Very powerful loan to get when you buy a house. But then again, if you have a solid credit score and a solid income, you can get into a conventional loan if you don't have the 20% down payment. And then again, you have many options that you can work from. So this is a very, very powerful loan that is very accessible to people that have solid income and solid credit. Once you reach that 20%, your PMI will typically come off and you don't have to pay that anymore. All right, so to recap, we talked about 4 types of loans that are out there right now. And then note that there's all kinds of loans that you can get into. But I just wanted to talk about the 4 basic ones to not make it very complicated in this video. But we essentially talked about the VA loan, the USDA loan, the FHA loan, and then the conventional loan, which are very typical. And then again, depending on your financial situation, where you are right now in life, as far as your finances, whether you have kids, you're married, you're single, it will all depend. So again, you have to assess it through a lender that will talk to you about what your options are. If you still are not too sure about it and you don't know which lender to go to, you can always get with the realtor. A solid realtor will talk to you about your finances, what kind of debt do you have, and essentially he or she can pre-qualify you and let you know whether it doesn't make sense right now at the moment to buy a house. As we're making this video right now on January 2022, which is the 19th of January, interest rates are on the rise. And so very important to know that if you're gonna get into a house that you have and you have the down payment, that you do it now. You might say, well, you're saying that because you're a realtor. No, I'm saying that because that is where we're heading. We're facing inflation right now. And so it's very important to understand how our economy is working. And then as demand keeps rising and then inventory keeps shrinking, but interest rates keep raising, the prices might level off a little bit. But will they crash like 2008? Most likely not. Will they crash eventually in the future? There's a big possibility that they will, right? But at least what it is the highest now, and if they continue to rise, when they do drop, what is going to be its lowest is what is currently its highest. So take a look at history so you can understand that a little bit more. But that is not the whole sole purpose of my video today. Today's purpose was to tell you and to teach you about how you can get into a home using this type of 4 loans that we just talked about. Should you have any questions, feel free to let me know. Drop it down in the comment section or send me a text. All of my contact information is going to be at the beginning of the video or at the end of the video. I'll be happy to help you. If you're living in the Southern California area, you know that I'll be here for you. If you live in another state, I can always connect you with a great lender and a good realtor that can help you out with this journey in your life in purchasing a new home. With that being said, thank you so much guys for watching this video. Please don't forget to like it. You will help me deliver the message to the community that is looking to get into a house and they really don't know that information. I will appreciate if you can help me by doing so. Until then, take care everybody. It was great talking to you guys today. Bye-bye.